Panelists introduce themselves. We have 4 experts here. Let's start off with Bill.
Great.
Sure. Is it on?
Hello? Now it is.
Yeah.
First of all, good afternoon, everybody. Thank you, Naomi, and panelists. Good to see everybody. My name is Bill Amity. I'm from the SPDR ETF business. I head up our fixed income group. So I spend a lot of my time thinking about and looking at our overall fixed income lineup, how we're positioning it with clients, getting feedback from clients, thinking about new product ideas, and overall, kind of different revenue strategies and sales strategies within our fixed income business.
Thank you, Bill. David?
Hey, everybody. My name is David Sharp. I'm at Vanguard within our ETF Capital Markets group. Our group is really focused on the trading and liquidity of our ETF products at Vanguard, really trying to create the best experience for our clients when they're buying and selling our products. We do that a number of ways, working really closely with the ecosystem, people like NAOMI and GTS, the exchanges, other APs. We monitor our products for product health throughout the day, for bid and offer spreads and premiums and discounts. And then we take a lot of that knowledge and we work really closely with clients to, again, make sure they have a good experience when they're going to trade, talking about best practices, or just implementation for a particular strategy.
Thank you. Jason?
Yeah, hi. My name is Jason Bloom. I manage fixed income and commodities product strategy and research and market strategy output for our team at Invesco from the ETF side of the business.
Thank you. Harley?
Hello, good afternoon. Hi over there in the corner. I'm Harley BASSMAN. I work with Simplify Asset Management. We're a new ETF issuer. Our clever idea is we take your ordinary beta in an ETF and we buy options. We don't sell the option, we buy the option, which is rather unique. So we accentuate the upside, cushion the downside. And we have 1.4 billion right now after about a year and change. The fund I created has about 300 million, which is kind of special. We'll talk about that. And before this, I was a Wall Street trader. I managed Merrill Lynch's mortgage trading and option trading for 26 years.
Thank you. So you guys have probably noticed from their introductions, we have a pretty diverse group of panelists. And I think that's going to be a very helpful take on fixed income as a whole. We have a few different issuers, and they all kind of work in various capacities. So, we're going to lay it on pretty tough because Q1, Russia-Ukraine war. We also have policymakers not being super agreeable. We also have COVID is back, and it's back tough, right? And inflation hasn't been a friend to us. So all of these things going on, how are we addressing the fixed income market, but also fixed income as a global ecosystem, and how has it evolved in the ETF space? So Bill, I'm going to start with you. From your time at Spiders, and you've been in Spiders for quite a while. We used to work together. And from your time at Spiders, you've seen the evolution of fixed income ETFs. Talk to us a little bit more about what's going on recently in this evolution of this space, what's working, what's not working, and what are you guys talking to clients about?
Sure. So I think I'm going to address this from a bit of the launch perspective.
Okay.
And we'll get into some other things as well. But it's been interesting over the past couple of years in terms of new products coming to market, right? For example, at Spider, we hadn't launched a new fixed income product since about 2015, 16, and in the past year or so, we've launched about 4 or 5. I think there's a couple things going on, and one is really from the regulatory standpoint, and the other is from the competitive landscape standpoint, I'll say. So from the regulatory standpoint, this is as it relates to Rule 6011, which has really helped even the playing field for bringing new ETFs to market. So issuers can now have a quicker speed to market in terms of bringing ETFs to market. But also that rule is a bit nuanced where it also allows for some advantages in terms of flexibility for the portfolio management process in terms of negotiated baskets. So that's been really helpful for new entrants coming to market. And the whole point of this regulation was to make things more of an even playing field. And just to comment on that, what does that mean from the PM perspective? Well, if you think about your traditional equity ETF, an S&P 500 ETF, 500 names in it, a creation is 500 stocks in, 500 out on redemption. In the fixed income world, I'll use one of our high yield ETFs, maybe it has 1,000 CUSIPs. These are typically negotiated baskets or custom creates, so making it smaller. that allows a portfolio manager a lot more flexibility. So I think that has changed the landscape for people to bring new products to market and have that create redeem process a little bit easier. And then from the competitive landscape, certainly we've seen a lot of asset managers. I think if you look at the list of the top 10, 20 asset managers, they all have either brought ETFs to market or have filed or have talked about it publicly. So why is that? Well, I think that's because they're seeing the opportunity here. They're seeing a bit of flows going from mutual funds to the ETF complex.
Sorry, his mic's going out.
I think the battery's low.
Yeah.
And so that's been more of an opportunity for asset managers, and they're focusing or have been focused on what I would consider, the ultra short duration area. I know we had folks on earlier panels talking about that part of the market, and that's really an easy way for folks to get into the market. It can help differentiate them. So these are more active type products or niche type products. Those products also carry a higher TER on them, so it makes it more attractive for some of these asset managers to get in. And then certainly on the demand side, we're seeing increased investor education, and that's allowing for these folks to bring them in.
I think that's a great point, and Dave, I apologize I didn't prep you on this, but I think you can talk about this with your eyes closed. Bill brought up barriers to entry, right? And there's not as much of a barrier to entry in bringing in fixed income ETF to market. From your time at Vanguard in that space, can you touch on what Bill just said in terms of barriers to entry there?
Yeah, I mean, I think when we look at, our lineup is naturally pretty concise, and, we did have the opportunity to do customs within our lineup. We were one of the folks that were grandfathered in initially. So when we bring, products to the market, we're really thoughtful of what is going to be the enduring client demand for the product. We want to be able to bring, a product in that the clients are really going to want to have for a long term. It's usually going to be a little bit more diversified, less thematic than others, but the most recent product that we launched in that space was our ultra short product, which is our first active fixed income. And for us, there was a bit of discussion internally on how does it look for capacity, some of the other issues that could exist as you bring a product to market, that could end up, hitting certain capacity issues. Where can you put all that money to work? Can you, are you going to start to show too much of your hand of what you're buying or what you're selling? So, those were some of the considerations we had with that product. As it relates to 6011, as Bill mentioned, I mean, that really did open up a lot of new issuers. We've seen, somewhere in the realm of 65 new issuers coming to the market since the ETF rule started to lower that barrier of entry, because the prior to that, for all the years from 1993 until that rule went into place just in 2020, you needed this exemptive relief process. There was a big slog within your legal department to be able to go through and get that approval from the SEC. And with that entry coming down, with that barrier coming down for entry, I think we'll continue to see new products come in. And I personally love it. I don't know if everyone at Vanguard loves it, but I love the new competition that comes in, the innovation that the ETF provides. It brings more attention to the product. It brings more clients to the space and the products. And I think it's a really exciting time within the industry as we have more and more parties come in with really creative ideas and really give the clients a lot of opportunities to implement what their strategies are, all the way down to the bottom of the strategy that they want to deploy.
Yeah, and I think you're getting more client adoption as a result of it as well. And I think from both of your comments, the term active ETFs have come up a couple times. Jason and Bill would love for you guys to comment on active, because are we still at the place where we're at that race to zero and no one wants to pay 70 bips? I don't think so, but would love to hear your thoughts as an issuer.
Yeah, sure. So, no, we've had a lot of success at Invesco with active fixed income. I think that my impression and my team's impression, as we're talking to clients on a daily basis, is that there's a high appetite for active and fixed income, where you have a much less homogeneous market and a market with a lot less efficiency in the underlying sort of ecosystem, and there's opportunities for active managers to take advantage of the idiosyncratic factors that constantly rise up in fixed income that are just different structurally from what you're facing in exchange traded equities. And I don't see that diminishing. In fact, I think that when you're in an extremely low rate environment and vol is extremely low, then fees become extremely important. And then when vol picks up and you're starting to see dispersion, hundreds if not thousands of basis points a year in performance, then 10 bips in fees, that suddenly goes away. People want the quality behind it.
Which we're definitely in.
So yeah, I think it's fee pressures, I would say, from a commercial standpoint, are declining. People, if they can get a strategy that's really effective in managing the current environment, they're willing to pay 10 or 20 basis points a year more to get that, and in some cases maybe even a little bit more than that.
Harley, Bill, do you guys have any comments on the active? I know a lot of your stuff that you launch is not traditional. Any comments on the adoption of active ETFs and what you've seen? I
mean, active ETFs are fine. You're at the micro level of picking individual securities, and it's a fine idea, and people can go and do that. I'm more interested actually in the higher level concept of what's going to drive the macro, and then adjusting the performance accordingly. So we'll go and overlay. SEC rule changes have allowed us to put derivatives into ETFs, which was not really viable before. And when you do that, you can really kind of steer the ship left or right and accentuate the gains and, more importantly, cushion the losses. And when you do the loss cushioning, so you buy puts, within the ETF, it becomes massively more efficient, both tax-wise and reinvestment-wise. So for instance, one of our ETFs, our biggest SPD, you give us $100, we'll put $98 into SPY or IVV, one of the ETF, indexes, and then we'll put $2 into buying out-of-the-money puts. And this is extraordinarily advantageous because if the market trades down, you get the cushioning effect as if you owned a tail hedge fund. But because it's inside the ETF, so that $2 becomes 10, right? We have an algorithm, we cash it out, we reinvest 2, the $8 profit goes and immediately buys more SPY. Think about if you were an ordinary investor and you have your tail hedge as an external entity, the down event happens, you make the profit, but now you have a taxable event, number one, and number two, are you going to go and be able to reinvest that money into the market again? So if you look back how we performed or when these drawdowns, when they snap back up again, we've bought back in at the lows, whereas if you have an external manager doing it, it could take you a couple of months to get your money out. So we're really working on the efficiency and operational, which adds a lot of value. Thank you.
And with the current fixed income environment, I'm sure we have a lot to say about that, but rates are rising, they've risen. Fed's expected to raise rates quite a bit more times. Bill, what are you guys, I know you guys come out with Bond Compass and a lot of material on what investors should really look to or what they should do. What are some of your firm's recommendations or your own personal recommendations?
Sure. So thanks. There's a couple things that we've been speaking about with clients, and I'll talk about 3 different topics. One is in this volatility, kind of thinking about cash or cash-like products. So really in the form of T-bills, ETFs that are wrapping up T-bills. So it's unique or it's important for 2 reasons. One, because it really helps you in this time of volatility, right? Preservation of capital is key. And also, if you think about how the yield curve is shaped right now, it's very steep in really the 1 month to about the 2-year point, and then it kinked a little bit relatively flat. So really, these products that are capturing that very steepness of the curve and allow you now to actually earn some income into your portfolio while at the same time having that stability. If you think about these type of products, even 3, 4, 5, 6 months ago, when rates are 0, they're not going to have any dividend income out of them. But now they're going to start to see some dividend income. So that's definitely something we're seeing a lot of inflows into those type of products. Floating rate products have been very popular. Certainly in the beginning of the year, if you think about the move in fixed income assets was really a rate-driven move in the first couple months or so. And that was really, we saw folks moving out of, say, high yield, fixed rate bonds into floating rate, particularly senior loans, floating rate IG. So that was very popular. Candidly, more recently, credit across the board is getting hit. So over the past 6 to 8 weeks, there's really, those aren't places to hide anymore. But we do think those are still good investments because of the floating rate nature, thinking about if rates continue to go up, you're cushioned on that perspective. And then one area that's probably a little bit off the radar is municipals.
I'm just going to ask, yeah.
You know, we've had some folks, you know, looking at municipals more closely. One of the things, we have a couple funds out there, some index type funds, some active municipal funds as well. And we actually use a sub-advisor. We use Nuveen as our sub-advisor for our muni funds. But as of last Friday, one of the key metrics that folks look at is the muni to treasury ratio. And again, I haven't looked at what rates are today. I'm sure they're all over. But as of last Friday, if you look at the 10-year maturity bucket there, that ratio of the muni yield to treasury was almost 100%, right? And that's the pre-tax yield on munis. And that's a ratio that historically in that bucket, in that maturity bucket, is around 80%. Right, so now you're getting up to 100%, and on that metric, it screens as a bit cheap for municipals relative to Treasury. So we are seeing people look at the municipal bond area and executing that through ETFs.
Jason, I feel like you want to say something.
Yeah, no, I was just kept nodding my head because it's really impressive to see the rise that we've seen in muni yields, especially in that sort of like 3 to 8 year maturity band. Where you're not taking on necessarily too much duration risk, and so you're going from A- corporate, you can go up to AA- muni and pick up 30 basis points of yield on a taxable equivalent basis. So we've been kind of like pulling our hair out and banging our head against the table, everybody's coming in and going out of high yield and into investment grade corporates. Yeah. And they're literally munis for some reason. I don't know if it was just the lost decade or whatever with the ultra low yields, but they've just forgotten about munis. And there's really some incredible value out there. And I think that's a big part of the conversation right now is our view is that the economic regime has flipped. Right? Everybody, the recency bias of that 2011 through 2019 timeframe is taken a lot of work to overcome. Everybody seems to think that as the COVID fades, that things are going to sort of go back to the way they were. And then that's probably true, but I think what we're going back to isn't 2018. I think it's going to be something, well, whether it's the 60s, the 70s, or the 90s, probably not the 80s, it's going to be something with a higher vol, higher inflation, higher rate environment, and getting people are slowly starting to realize I need to think differently about fixed income than I have over the last 10 years. It's a new economic environment that we're operating in, and it's exciting because there's a lot of money in motion. People are down 10% in their core investment grade fund. They're happy to sell that, harvest the loss, and then the conversation is, well, now what should I do? Like, what are rates going to be in a year? What's inflation going to be in a year? And the Fed hasn't even come close on that, so there's some interesting conversations. And since we have a huge presence on the commodity side, and because that figures so prominently into some of the inflation dynamics and economic challenges we're facing right now, it's usually a combination of commodities, rates, and then also getting people to think about munis again. I'd say that's like 80% of our conversations on a daily basis.
You said 80%?
Yeah.
I would say from a market timing standpoint, I would definitely be looking at muni bonds right now. They've been annihilated. You could buy California AA munis at 4 1/8. New York is probably in the similar area, and you get like 20-year stuff callable in 5 years because the option value has gone up. I mean, if you can get 4% or better, triple tax-free in New York and California, you're talking an 8% pre-tax yield at the top bracket. I mean, that's an equity-style return.
When you can't find anything else really right now.
I mean, as far as doing them in ETF might be more challenging, and if we can create ETFs that can target that sector of the market, because you're getting, retail who's gotten scared, they're just whacking bids and knocking things out right now. And I mean, if you can get a AA California or New York muni 100 over the curve, that's just the wrong price.
Yeah, you actually can do that in ETF. We have a New York and a California. So there you go.
There is. The ETF space, I know an earlier panel said this, the muni ETFs have seen more flows than funds, and it's been like 10x. Yeah. So that kind of leads me to you, David. How does the ETF structure work in fixed income? Thinking about munis, right? Why is it more efficient? Jason mentioned there's a lot of money in motion. Us that work at trading firms, there's a lot of money in motion. And how do we educate investors? But why is this a more efficient wrapper? I mean, even with something like munis.
Yeah, I mean, I think we've naturally seen, the tax loss harvest trade has been really strong in munis naturally. And we launched our muni product. We just have one currently, a broad market product, VTEB, that's gained about $15 billion in assets until it got whacked down about 10% recently. It used to be a little bit more, but we launched that at $50. It's now below $50. So even though that was 7.5 years ago, we're below that level. Now, total return naturally has been higher, but we are finally seeing a lot of clients that are looking at, they might be doing a little bit of tax loss harvest out of VTEB, but we're seeing a lot of people that were naturally in open-ended mutual funds that now see an opportunity to harvest those losses in those funds, and the ETFs are winning a lot of that, whether it be our product, Bill's product, BlackRock's product. I'm sure Jason's seen a lot too. We're seeing some record inflows. We had our largest inflow into VTEB in its history just 2 weeks ago because of that trade that's taking place. And I think it's an easy landing spot because the cost to get in and out of it, the PM isn't going to constrain that to avoid hitting those back bids in a big sell-off environment. They need to constrain some of that flow. That impact is democratized into the ETF. And one of the great things that the ETF has available to it is 2 layers of liquidity. You're first going to go and exchange shares with other parties that might see an opportunity to buy VTEB or other funds, or are looking at just a rel-val opportunity, or the yield is at a good level now that they like, and they want to buy as other people are choosing to sell. And you can cross that right in the secondary market. You don't even have to touch the primary liquidity that could be constrained. And we see about 80% or more of all volume stays in the secondary market. What we call the secondary market ratio continues even in this environment, is staying at 80% or more there. And that really helps to buffer the liquidity in that ETF structure before you then have to tap into the primary market, where you're naturally going to run into greater liquidity constraints. And I think that's always been something that's been really great for fixed income ETFs, to allow, when you look at the underlying basket, what would be my spread if I sold the whole portfolio and then bought it back immediately? How much am I paying to cross that? What's my liquidity cost? And when you see the ETF, it is often at a fraction of that value because of those 2 layers of liquidity. Something like long-term corporates, it's the most extreme example, where you have baskets that might be 50 basis points wide, and our product trades at 3 to 4 basis points because of those 2 layers of liquidity. Mm-hmm. I think more and more clients are realizing that potential, that opportunity to be able to use a tactical investment into the product, and also to reduce your cost even for a strategic investment you might have in those products.
So we talked about client education, because for a client to know that, whether it's intermediary or institutional, and that secondary layer of liquidity, and that it could be 4 versus 50, how does your team help educate your potential clients and why the ETF wrapper is more efficient? We've all been there, from an issuer standpoint and working with clients to educate, but how does your capital markets team do that?
Yeah, we're really focused on, that is one of our core, buckets that we do, is that client services and thought leadership. And we offer a lot of different services to clients there. ETF education is one of those. And we really want to make sure that we're, talking to the clients about the best practices to implement and give any level of education. There's such a wide range of outcomes within the client space on their knowledge. And even, groups that you would think would be very sophisticated might be behind the curve on ETFs, where they just haven't used the product. They've used, the underlying security. So we, really focus on thought leadership to try to get, a broader viewpoint out to the market. But we're available. We have a hotline that we answer. We'll set up with our distribution folks different meetings to be able to talk through that. And then we offer additional services from our desk, which I'm sure my issuer peers here do as well, of giving some insights to pre-trade. If you're going to do a rebalance, which is, besides the tax loss harvest trade, the rebalance activity has been really strong as people reallocate their assets in this environment. And we want to give them the opportunity to think about, how much is it going to cost for you to do that? We'll give you an estimate on what we think that could be. We can give you real-time guidance. What do we think the underlying securities are worth at any given point in time? We have tools that we've built to try to analyze for that. And then giving post-trade analytics to make sure that you feel comfortable with how did you execute. And I think what's really important there sometimes is clients will look solely at, how did I execute relative to the ETF's bid or offer in the market? And what we want to show to the clients is, what was the cost of the underlying? What was the creation cost? What was the redemption value at any given point in time? And how well did you do versus that? Because that is really where you're going to get the insight to how much better you might have done by using the ETF as your investment vehicle for whatever strategy you might have.
Thank you. And the one other point I would add to the liquidity and the additional layer conversation is we've seen a lot of conversions from a lead market maker standpoint from mutual funds to ETFs and that wrapper and the tax efficiency of that. So that leads me into tax loss harvesting and the tax efficiency. I mean, even from just the mutual fund conversion to the ETF. Jason, it looks like you have a comment there.
Well, yeah, it's sort of just a little bit of an add-on on top of the efficiency of the trading. There's sort of a fairness issue too. Right? What you really want to avoid is being one of the last holders of a mutual fund that's selling down, because the PMs have to hit the bid and raise cash internally and cross the spread, incur that transaction. And if you're staying in the fund, all of those costs are being passed on to you as the remaining shareholder, whereas with the ETF, because of the in-kind redemption process, especially on the redemption side, is we can simply put the bonds out in kind, right? The ETF is going to trade based on where that basket of bonds is trading. But the idea here is you're just slicing off a pro rata piece of the portfolio, delivering it out, and you're not creating transaction costs internally that are being spread to the shareholders who don't want to panic and sell, or just don't want to sell and want to stay in for a longer term reason. Yeah, much more fair.
Yeah, we often will say it democratizes those costs, right? It's just that individual that's choosing to sell and needs that liquidity right there. They're going to pay that cost of liquidity. And I think that's another just great part of the product, because it really just applies that to that individual. To Jason's point, anyone left in the fund is just kind of left holding the bag for underperformance if they have to hit back bids to sell in the open-ended mutual fund.
Exactly. And thinking about going back to the general fixed income landscape, we talked a little bit in the beginning about the geopolitical environment and inflation. Harley, this one's for you. With with the current geopolitical environment and rates being extremely high, inflation being high, what do you recommend to investors? Because I think every single panelist here recommended the 60-40 traditional portfolio. That's not working, right? Like it's really not working. A diversified fixed income portfolio is not getting your clients any returns, or maybe even at points negative returns. So what do you recommend people do in this environment with all the noise going on?
I think the most important thing to recognize right now is clearly the Fed's, we have inflation. Is it transitory? I don't think so. Some people do. The Fed's taking rates up. We got that email. What's strange right now is the yield curve is inverting, or trying to invert, very early on. As a matter of fact, I mean, it basically you had twos, tens inverting before the first hike. This doesn't happen. Usually this happens like the second to last hike. So we're getting, this message from the yield curve that there could be a recession coming on, and that's why equities are headed south. The problem is maybe the Fed's going to keep on going. Maybe Jay Powell does not want to be known as the Arthur Burns. He would rather be known as Paul Volcker, and he's really going to, power raise rates up. So what this leads to is historically, you've seen 60-40 work because stocks and bonds for the last 20 years go in opposite directions. Stocks up, bonds down. They act as a hedging vehicle. They reduce the volatility of a portfolio, right? And if you add leverage to it, you become a billionaire, a la Ray Dalio, right? Risk parity. What's concerning is if you get rates up above a certain level, looks like around 4%, you very likely will see that correlation flip and stocks and bonds both go down together. And that should be your concern with your portfolios right now. We offer a product, PIFIX, PFIX, which is specifically designed for this problem. It's what we've taken advantage of legal changes, and we've embedded a 7-year put effectively on the 30-year Treasury and put it into an ETF. So it's a direct drive relationship with interest rates. I think it's the highest performing ETF in the country this year. As of last week, it was up about 65%. It wasn't genius. I mean, the Fed took rates up by 100 bips and there it went. And if rates go back down again, so we advise, this is what we like is finding ways to, kind of hedge out this risk of rates going up. Will they go higher? I don't know. The other thing I would advise you to think about here, and I don't have the answer, is that I feel pretty comfortable saying that inflation is going to remain high. It's not transitory. It was 8. It's probably a clip around 6. I think it'll easily be well above 4 for the next 18 months. There's so much inflation built into the market that has not arrived yet. For instance, housing makes up a third of inflation, and housing is not housing prices, it's done by what's called OER, which is basically rent. There's a 9-month lag on this, so it's just cooking. Question is, are rates actually related to inflation? And that's what we don't know right now, because you have not seen rates move with inflation. And so don't get hung up on inflation's going up, so I'm going to be bearish. You got to think about what will rates do. I think the Fed does not want to have, the Fed's happy to have that negative relationship. So that's kind of where I am. I'm stumbling around here. I think rates should be higher. I think as a public policy measure, a steeper curve and higher rates is good for, a financial civilization, for insurance companies, for pensions, for investors, for all various reasons. It's a good public policy idea. It strengthens the financial system. We're a financial economy. But does the Fed want to do it? I think what we're going to find out in the next 6 months when we turn over this last card is when the Fed stops buying 100 billion bonds a month, what's going to happen?
Yeah.
And we don't know yet. So there's one more card to turn over at the poker table, and we're going to find out then.
One second, Jason, 1 second.
Okay.
Because I think you mentioned a word that we've heard from some clients and peers, and that's recession, right? And so question for the audience, how many of you heard, the phrase recession in the past 2 weeks? Raise your hands. Almost everyone, right? And so, Harley, I thank you for that point, because I think you hit a concern spot on. Yeah. Jason, go ahead.
Yeah, I mean, one of our products, the Bullet Shares, allows you to build a ladder, right? In various munis, corporates, whatever, all the way out to 10 years. And so a lot of times we're talking about clients are asking us, well, is it time to add duration? Should I be buying 2 years or 5 years or 10 years? And there have been some big commentators, some big asset managers that a few weeks ago when the 10-year hit 3% said, this is it, it's time to add duration. And I'm scratching my head going, thinking that they're coming out with that much conviction that this is as far as we're going to go, because QT hasn't even started yet. To his point, you're going to see 95 billion a month of purchases coming out of the market. We haven't seen a yield curve undistorted by QE since, 10 years ago. Because even if the Fed is going to QT, once they come out of the market, we've been importing QE from Europe and even somewhat from Japan even before that. So if you look at the Bund, 10-year Bund spread, doesn't like to get much past 200 basis points. It's sort of where the leash pulls tight. Well, Bund yields have gone from 10 basis points to 110 basis points in the last 2.5 months. So we're seeing skyrocketing yields in Europe, which is going to allow yields on a relative value basis to continue to rise here. And if you look back to the last 2 times, the 10-year went more than 400 basis points below the current CPI print. It happened twice, in the mid-70s and 1980. Once that process reversed, in other words, once real yields bottomed and the 10-year started to catch up to CPI, the 10-year yield was above nominal CPI within 1 year. It was a violent reversal. Now, most of the work was done by CPI coming down, right? But so, even if CPI gets to 3 or 4% by year end, and even over the last 30 years, it was pretty unusual for the 10-year to trade more than 100 basis points. Or a 10-year is usually trading around 100 or 200 basis points above CPI. So again, what I'm getting at is if we get into a world where the curve is undistorted by massive central bank intervention, it would be completely average for the 10-year to be at 4 to 4.5% by year end. Now,
that's a call. That's a call right there.
Yeah, there's a few assumptions in that. But what I'm saying is I don't think it's a tail risk.
Okay.
I think it's within a reasonable range of probabilities that we're closer to 4 than 3 by year end. But that apparently is way out of consensus right now.
So you touched on a question I had for you, which is duration. Mm-hmm. And I think when you're thinking about core fixed income, and we've seen duration creep up over the past couple years, this affects yields, this affects expected returns. Yeah. What do you tell clients, especially with a traditional fixed income portfolio?
Yeah, I mean, and I
What
think,
do they do to duration? I'm curious to hear Bill's comments on it as well.
Yeah, and well, and sort of following on Bill's comments earlier, absolutely floating rate. People kind of loaded up on bank loans last year, so this year investment grade floating rate as spreads start to widen. We have an actively managed investment grade floating rate, as well as actually, you know what? T-bills are starting to look really interesting. I can't believe I'm saying that, but it's true, right? I mean, yields are rising steeply, and you get rid of the duration risk, and the returns on literally a T-bill portfolio are pretty attractive in today's environment.
Bill, you mentioned floating rate earlier. Do you have additional?
Yeah, I mean, look, we talked about floating rate, T-bills, munis. I think, you know, one area that maybe is attractive too is if you're going to take a flyers converts.
Bill, sorry, your mic is going in.
Mic 3.
It's a plot.
Thinking about, you know, kind of taking something, a little bit of a flyers converts, right? We're looking at that. A lot of that drawdown has been in the equity component of those securities, really pulling that area down. But you do still have, you know, you do get a small yield on that, and you will have some equity upside, certainly, if the market does rally. But again, thinking about, you know, a lot of safety. Folks are talking about potentially adding duration, maybe looking to the middle of the curve, not really on the long end. So again, I think T-bills have been very effective as well, just for a short-term period. But one of the things I do want to mention, you know, we talked about tax loss harvesting, and I think that's really something that should be considered. We're seeing a lot of that happen across fixed income. I think within ETFs, about 95+% of all fixed income ETFs are down. And we're also seeing I think, David, you mentioned this, the migration from mutual funds active into ETFs as an opportunity within the tax loss harvesting arena. And just to put some numbers on it, if you think about the fixed income ETF market of about 1.2 trillion or so, about 88% of that is index fixed income, right? And roughly 12% is active products. If you look at the mutual fund complex, it's almost the exact opposite. Right? So it's like 82%, which is roughly $4 trillion, is active mutual funds, and less than $1 billion, or, you know, kind of 18% is index mutual funds. So I think that's where we're also seeing a big opportunity. You get your statement, you see you've got an active mutual fund that's down, and this is an opportunity, and that's where we're seeing some folks moving from mutual funds into fixed income, active or indexed ETFs.
Well, we weren't going to bring one part up, but I'm going to bring it up, and that's, you know, semi and non-transparent. So it's starting to be adopted in the equity ETF space, not in the fixed income space. Some people say we're very far away from it. We talked about this in our panel discussion. We said, should we bring it up? I don't know, but I think we should because of that conversion. So you have the mutual funds mostly being active, and then ETFs, 88%, you said, passive in fixed income, non-active.
Exactly. Well, so from our shop at SPDR, all of our active funds are fully transparent. Mm-hmm. So we have daily disclosure of holdings on our website. So that's, you know, and again, we use sub-advisors for our active products. They're managing the funds, and we keep track of all the holdings on a daily, weekly, monthly basis. So we are in the you know, full transparency camp currently.
David, from your seat and what we've seen in the equity space with, you know, the Presidian model and various models in semi and non-transparent, hasn't come to the fixed income space yet, but, you know, as active grows in the fixed income space and active managers want to enter, do you think this is something down the road?
Yeah, I mean, I think the tough part will be getting the regulators convinced too, because it's still not available there. It's really just large cap equity that they've blessed for those, you know, less transparent wrappers. So if that hurdle, you know, is crossed, there's no reason to believe that you can't do something similar that you're doing on the equity side. I mean, even in the creation process that you have with any funds, if I just use our total bond market's the most extreme example, it has over 11,000 securities from the aggregate bond market in it. If we ever needed 11,000 bonds to create, we'd have exactly 0 creates in BND in its history. So we, of course, need to do optimized baskets, and they're highly optimized. Sometimes we're creating, you know, $100 million of total bond with just 200 bonds. So there's an element there, as long as you are hitting the right risk attributes in creation and you can help the The market makers understand what the risk is within the portfolio, even if they don't see all of the holdings on a daily basis. I don't see a reason why you couldn't have a proxy type of portfolio allow you to do an active strategy in fixed income. I really think that there is opportunities there, and I think it's a compelling time to look at active in the bond market naturally, as we have had such volatility in rates, and I think we're just at the precipice of a possible credit widening as well, as we use the R word, which I won't say out loud. I'm not going to jinx anything, but I think
Harley will say it for you.
Yeah, I mean I think there's potential there, and it's really just a matter of the regulators feeling more comfortable, and I think some of that's just going to be the conversations. It took a while for the equities to come in there, because there was this belief that a lack of transparency there would have a negative effect on investors, and I think it was proven out even within Vanguard's lineup. We don't have all daily disclosure, and you could still track well and still have a good experience in the products, and then bring the certain structures to the market, and they've performed pretty well. Sometimes a little bit wider spreads in certain instances, but for the most part, I don't see any reason to believe you couldn't, go down a path to introduce that on the fixed income side.
And I think, as we talked about earlier, it's going to take a lot more investor education, as we had to do initially for fixed income ETFs. Speaking of the education, March of 2020. And
I've repressed most of March of 2020.
March of 2020. I'm going to bring it back up. What we've seen, essentially in the fixed income ETF market is that dislocation a bit, right? And the pricing mishap there, and the dislocation and investor mistrust of, is this really tracking? Are we getting the actual bond pricing? And we had a lot of those conversations with clients. Whatever shop you were, you had a conversation with your end client about, why is this not matching up here? How, Jason, I would love your take on this, because how have clients overcome that a bit? And how have we positioned ourselves now in the overall ETF community?
I'm so glad that March 2020 happened, in the sense that, for years and years, the critics have been saying that fixed income ETFs have created this bubble, essentially, right? That they're going to destroy, implode. It's going to be the next crisis. They're going to wreck the over-the-counter fixed income market, and of course. And they weren't exactly objective critiques, but they were very loud and they were very prevalent, and it was amazing. I remember being, we're all on the desk, right, hunkered down, taking client calls, and then all dealing with the panic. And I remember one of the PMs saying, Nuveen's trying to sell 400 million of munis right now, and there are no bids. And I'm looking on the screen, and our muni ETFs are trading, and they're trading well. Price discovery is occurring, right? Now, sure, the bid-ask spreads are wider, but they were tolerable. Price discovery in that environment occurred. The ETFs never imploded, and it proved out, exactly the points, that were made, that we've added liquidity to the system. It was a beautiful test case. There was like one last Hail Mary article. Someone later, I think it was at the Bank of International Settlements, tried to cut up some ETFs, and we debunked that, right? And that's I haven't heard anything since. So fine. See, maybe I think we're past that.
Harley, I would love to hear your comments on March of 2020 and debunking this myth.
Well, I mean, the Fed did kind of come in and save the day, so
a bit.
let's look at carried away over here.
Yeah, I mean, we were fine.
It was a little frightening back then. I mean, ETFs offer a value clearly, and when we get, will the Fed push the string hard enough to cause a bigger problem? Unclear. I guess we'll find out. I mean, my thinking in general is, I'll let you guys go duke out the nips to blips in active and try and squeeze out a few pennies here and there. But my bigger idea is, if I can catch the big thought, like, hey man, the horses went that away, I'm probably going to win. So if I go and take a generic index-style portfolio and then overlay an option strategy into it, where I'm buying the option, not selling the option. Let's be very clear. Most ETFs and most kind of structures, people are selling the optionality to increase the short-term yield, the stated yield or dividend. That's the eye candy. What's the downside to that? Well, the downside is that if you sell an option, you have limited gain, unlimited loss. I think the other side of the coin is much more advantageous, where you buy a little bit of insurance and then you could ride out any kind of dislocation. And that's what we're doing over here. We have equity funds and we have bond funds where we basically, buy index ETFs and then we overlay a bond, so a convexity, an option strategy in there. So if things get hairy, you're going to survive it, and that kind of works. Are we going to go? I mean, I want to circle back to the R word over here. I think it's important to remember one thing. It's never different this time. Okay, I've been doing this for a very long time over here, and I will tell you that every single time we get some kind of event, either March or whatever it might have been, everyone says, oh, this is the worst, this has never happened before. Let me assure you, we have not invented tragedy. It has always happened before. It's just different people seeing it, and we will see it again. And so the notion really is to be prepared for what's coming down the pipe. And all of you in here, what I would say is just make sure you're not over-levered and that you're not invested in some kind of product or structure where you're negatively convex, where you're selling an optionality, and that includes, being too low in the credit curve, or some other way that you're creating a portfolio. That's kind of your job, is to go and kind of think of that thought. If you don't get exposed to this negative convexity, negative leverage, you could ride things out. You could even ride out March. The problem with March 2020 was that people sold and didn't get back in. Yeah. If you have the ability to go ride it out, you'll be okay.
Maybe one more comment I'd just make around March 2020 was, kind of the story of, the ETFs are going to fail, and they didn't. And I think, the shock absorber nature of it certainly helped to support that ecosystem. But I think what's really compelling is, I think we were even looking at it at Vanguard and seeing some of the large stated discounts or perceived discounts, I would say, because that's probably the real true fair value of those bonds at that time, was that there's fear of, is this going to, hurt the franchise and hurt fixed income ETFs in the future with this kind of blip for anybody that pulls up a NAV chart and sees that. And what I think, what we saw was that if money talks, it screamed that a lot of clients appreciated the ability to still have a bid. Mm-hmm. To Jason's point where, munis, you go out and they're trying to, you can't even get a bid. If you have a basket of bonds and 40% of those you're having trouble even getting a bid, what is the value of that portfolio relative to an ETF that always has a bid available for you? Whether you like that bid or not is up to you, but there's a bid there, there's someone there that's willing to commit that liquidity, and you can find that liquidity if you needed it, if you absolutely needed it. To Harley's point, hopefully you didn't, because all you had to do was ride out 2 weeks and you were back to, at least the premiums, were leveled out, the premiums and discounts. But, if you can ride it out, it proved that you had this liquidity sleeve, and we saw adoption from new parties that wanted that after that event, and we've seen, pretty heavy inflows into fixed income ETFs from that event.
And I mean, also thinking about, Harley, to your comment, it was a month. If you could have held on tight for a month or so. In this case, we're dealing with a bit more than a month, right? And so a lot of the conversations we're having, and many of you are probably having with your clients, is fear. This idea of fear: should we sell? Should we sell? Should we sell? We've seen a lot of that already. How do you talk to clients, Bill, Jason, in terms of hold on tight? Like what realistically puts them there and getting out of this fear mentality of selling?
Yeah, well,
oh
yeah, go ahead. No, go ahead.
So I think a couple things, right? You want to make sure that there's a balanced portfolio with a diverse kind of different sets of products, short term. I also think it's important to think about, and we haven't touched on this because we've really talked about active for most of this panel, but talking about liquidity. Right, and we've talked about the ETF being liquid, but making sure that you have those tools within your portfolio that are liquid, that if you do intend to sell for a tax loss harvesting reason or something else, that you do have a tool where you're not going to lose 1%, 2%, 3% on just an execution cost. And I think kind of going back to the discussion of March 2020, like what do we learn from that as it relates to now? I think we learned a couple things as it relates to fixed income ETFs. Number one is that the dislocation between a fund's NAV and the trading price is somewhat cosmetic, and that can be solved. And number two, that liquidity is very important. And so, one of the things that we've been doing, and we've done recently, is partnering up with some index managers who are really leveraging data in the market to think about liquidity as an input in indexation. And that's really something that's new to the market. We actually did launch a product last week with market access. So it's really the concept of taking liquidity as a key input into an index and designing the index around liquidity rather than some of the other traditional metrics that are there. These indices can be regulated and shaped so that they have the return profile and risk characteristics of broader indices. But again, I think the key component here, as it relates to investors as well, is really driving home the liquidity story with respect to ETFs, and that there are other options out there in the market.
Thank you, Bill. Jason?
Yeah, no, that's a great point. I think, well, okay, so if you're talking about dealing with fear and panic in fixed income, even if you look at previous recessions, it's very rare for investment-grade corporates to default, even in a recessionary environment. If you have a diversified basket of bonds, holding through that has historically absolutely been the best thing to do. You might see a little bit of return shaved off, from bonds that are downgraded, and if you're going to sell them. But honestly, it's quite minimal relative to the cost of panicking, selling, and then not being in the market when things rebound. Same thing on the equity side, but people are asking that question right now. Personally, no, I don't think we've capitulated yet. I'd like to see the VIX above 40 before I try to call the bottom. But that being said, if you look back, 100 years and look at drawdowns of 18 to 20% in the S&P, had you bought at that point in time, you would have been looking pretty good a year or two later. So it's not necessarily a terrible time to be buying. Certainly a lot better than 6 months ago. So it's taking that perspective. So, but in fixed income, I mean, in investment grade, panicking when things get wobbly has never paid off.
So you have a bid at 38.40 on the SPOOs?
Yeah, that's pretty good. I'd love to see 35.
So I'm going to open it up to the audience for some questions. I see the sign. Don't worry, I got you. In the back, Marcel. Need a mic in the back. Okay. We can go ahead with you first. You can go ahead.
Okay. Quick question. Hopefully it's not too far in the weeds, but the last time I was here, we had another fixed income panel, 3 or 4 years ago, and I asked about how you guys are taking these bonds.
Sorry, we're having trouble hearing you.
All right. Just wondering about how you guys are seeing these bonds actually trade. And I know you referenced the OTC corporate market. Just out of a guess, what percentage of credit is now trading on legitimate screens? Like you talk about you're working with market access, and I know that they have kind of a platform that they're using. Just kind of ballpark how much credit is actually trading on screens now as opposed to kind of old OTC.
So in the IG space, I think in the past couple of years it's gone from maybe the low 20s to the low 30s in terms of percent. So that's in IG credit. And so I think that's a trend that we're going to see. Now there are some markets that really are, munis, loans are still very much OTC, but IG credit is really an area where that's developed more. And so you do have a lot of folks out there who are building those platforms. But what's unique about it is that with those platforms, you have the ability to not just see a trade, like on Trace, but you have the ability to capture the bid and the offer, and kind of the second level and third level. So that's where there's real value in this, is not just identifying from electronic trading a trade that occurred in the market, but as these platforms, the value that they're bringing is saying, okay, this bond traded at X, but there were 4 bids and 4 offers. So now you can really define and create a liquidity metric, a liquidity score, to really look at a bond and say, this is where liquidity is. So it's not just based on a trade, but it's based on a number of other factors. So I think that's really where the value in the electronic trading is, and that gives investors a little bit more insight.
I would add that I'm not quite as sanguine as my cohorts over here about how the world's going to play out if we get a recession or some kind of problem in the world. I mean, it used to be the street would be the bucket of liquidity to go and solve the world's ills. That's not going to happen this time around for so many reasons. Aside from the fact they don't want to do it, regulatory-wise, they can't take, we can't take that kind of risk anymore. But that doesn't mean there'll be no liquidity. It means it'll be a different liquidity pocket that does it. I mean, Susquehanna and Citadel now do most of the liquidity in swaps and in options, which is not, you know, Goldman and Merrill doing it anymore. There are larger buckets of liquidity out there from private capital, large PE firms or elsewhere will take it down. So we haven't tested them yet, so I'm not saying it'll be a bad thing, but it'll be a different manner that we go about the process of dealing with a, I won't say systemic risk, but let's say a large risk.
Harley also met his BFFs at GTS. And I think that it's a good point. And I want to just ask Dave one question related to yours. And Bill brings up this point of the liquidity and that visibility for the end investor. You guys track some flows in the ETF space and in fixed income as well. From the flows you're tracking, are you sharing that publicly with clients and
Related to
just asset class flows?
Yeah, I mean, I think
investment grade, you know.
It's definitely something that a lot of clients, the trend conversation is something a lot of people want to see, especially as you go into certain institutional clients, just want to know what everyone else is kind of up to and what they're doing. And, you know, the trends that we're seeing are what you would expect given what we've been talking about for the last 50 minutes. It's coming down in duration and it's going up in quality for the most part. You know, if you were to look at the leaders across the board, which, you know, we all are participants in some of those leaders, they tend to be, you know, BIL from SPDR, I think, is #1 on the board right now. You know, that's what, 1 to 3 month Treasury. So, you know, that is kind of the way that it's going. I think a lot of people are paying attention to that. It's now a question, though, of what's next is certainly what everyone is kind of curious about, and obviously nobody really knows for sure. So it's a bit of, you know, sometimes those trends become a little bit too reactive, I think. So it'd be really interesting just to, you know, see, are we getting to a point where people feel that you can come in and get value and they feel comfortable where you're at? You know, and I would look to these guys that are more strategists to say for sure, but certainly those trends have been pretty consistent year to date in the lower duration and higher quality products.
Thank you. I know we had a question in the back.
Yeah, thanks. Apologies, I may have missed it, but I'd be curious to get the panel's views on the agency mortgage market today, especially Harley, given your expertise there.
Mortgage market is a screaming buy right here. It's playing the wrong price. As a matter of fact, so I've written about this. You can go to my website and look it up, convexitymaven.com, and I speak about the par mortgage rate versus the Treasury swap rate. It averages about 72, 75, like forever. It's at like 115 right now, which is just, it's kind of the wrong price. What's interesting is that we've seen the Fed back away from the market, right? They were buying $35 billion a month of mortgages, and we squeezed that spread into the high 30s, low 40s, which was also, by the way, the wrong price. They've gone away, and now we're like 115 over, which makes me wonder, is the mortgage market gone to the wrong price, or it's gone to the right price, and treasuries need to catch up, and once the Fed gets out of the way. I guess I'm not sure which way it's going to go, but if you could buy a Fannie 4 right now at 99.5 at 120 over 10s, and you have some convexity risk for sure, but there's zero credit risk. It's almost a no-brainer. I kind of like also, it's a little scary, but some of the levered mortgage REITs are very interesting here. I mean, I'm not going to start mentioning names, but I mean, you know what I'm talking about. You start taking on a 110, 115 over product levered 7, 8 to 1. That's not the wrong ticket. It's just going to be volatile. So, but yeah, I like mortgages a lot. Straight pass-throughs are fine. No reason to get fancy with CMOs or stuff like that.
Thank you. Any other questions in the audience? No? I think we scared them. Maybe with the... All right. Well, thank you guys for the time today. We appreciate it. If you have any questions for the panelists, we'll be around.